All right, my friends, Q&A. Got a question from Dave on my email. Hey, Josh, bought your book Tax Bomb, and I have a quick question on your example on page 40 with Dan and Sarah. He says, if their Social Security is $70K, their provisional income is $35K, which is taxable according to the table on page 18. It won't be much, 50% of $3K, but it's not tax-free. And he says, is there something I'm missing from your analysis? I get this question a lot, about how Social Security is taxed. And I want to dive into that real quickly because it's actually quite simple once you figure it out. Now maybe we'll use green. So let's dive right into this here, my friends. So welcome to Heritage Wealth Planning YouTube channel, the place you come to learn all about Social Security taxation. Once you figure this out, it's actually simple. But trust me, when I got this, like, man, I'm telling you, it's hard to remember how this works. Once you understand it, you get it, but you still find yourself going back and forth. Then you realize, oh yeah, I forgot. So let's draw it out. So in this case, we got, who do I got in my book? We got Dan and Sarah, and they have their only income is $70K from Social Security. All right, so we can say it doesn't really matter in this case who gets what. It's just 70. I probably should draw a little bit or make that a little bit cleaner. It doesn't matter who gets what. It's $70K. It could be 10 for Dan and 60 for Sarah. It doesn't matter. $70K Social Security. All right, so remember when we do provisional income, we take all of our income and add it to half of Social Security. All of the income, which includes taxes and interest. In this case, they got nothing but Social Security. Oh, by the way, do you know, let's just say Dan and Sarah were only spending, let's do this. This would be kind of interesting. Let's say Dan and Sarah were only spending $50K a year in income. Do you know what the probability of success would show on a Monte Carlo? 0, because they ran out of money. Did they run out of money? No, they didn't. They have money left over. Now, it depends if you're reinvesting that $20K or not. It doesn't matter. They got enough from Social Security to pay their bills, but the Monte Carlo would show you that they only have a 0% probability of success. So before you get too tied to the Monte Carlo, remember the probability of success is if you have liquid net worth. You could literally have $1 million a year in annuities paying you income, and only spending $100,000 a year, and your Monte Carlo would say 0. Now, again, if you're reinvesting it, it won't say that because it'll say, oh, you're building up a liquid net worth. But let's just say you have all the money you receive, everything you ever could possibly dream of, you had access to from a cash, from liquidity, not liquidity, liquid net worth, but from an income stream. Every single penny you could ever possibly spend, you had access to for that year, but you didn't save anything. It just all went into the wastebasket. It doesn't matter. You would still have a 0% probability of success because Monte Carlo only looks at liquidity at your death. Liquid net worth. You could have the Trump Tower, all right? You could own it outright without no mortgage, nothing. You could have all the income you need. You just snap your fingers, say, Uncle Grandpa, I need $1 million income. And Uncle Grandpa and Pizza Steve, that's a cartoon, by the way, Pizza Steve. If you don't have kids, you won't know what I'm talking about. It's a great cartoon. But Uncle Grandpa says, okay, Josh, here's $1 million. The next year, you go back to Uncle Grandpa and Pizza Steve, say, I need $2 million. And they say, here you go, Josh, here's $2 million. And you have the Trump Tower, which is $1 billion, trillion, million dollars. And you got billion, trillion, million dollars of income from Uncle Grandpa and Pizza Steve. But you have no liquid net worth. You know what your Monte Carlo says? 0. So anyway, I just like that because I always, people get so wrapped up with the Monte Carlo. And I'm like, if you got all the income you could possibly need, why do we care what the Monte Carlo says? Now, you might want to leave an asset to somebody. That's fine. Guess what? Buy a life insurance policy. But all right, be it as it may. All right, so remember, that's what the Monte Carlo says, 0. So I just had I segue quite a bit. I'm sorry. I run off on tangents. Get a refund, I suppose. All right, so in this case, we got $70K. So our provisional income is all your other asset, all your other income. In this case, they have no other income. No other income minus half your Social Security. So it's $35K, all right? So we take all their other income plus half of their Social Security. And so the provisional income is going to be, let me get my other pen here, $35K equals provisional income. All right, so remember how this works from a taxation perspective. All right, so let's just get rid of this. We know we got 70K of Social Security, 70K SS, 35K provisional. All right, so now what we do is we say how much of our provisional income is going to make our Social Security subject to taxation. And remember, married filing jointly, 0 to 32, 0, 32 to 44, 0.5, and then anything over 44 is 0.85. So we have 35 minus 32, 3,000 will be taxed at times 0.5. All right, so we know we have, what's that, $1,500. No, 3,000. Yeah, 3,000 times 1.5, so I have $1,500 of provisional income, of Social Security income that's subject to taxation. All right, so we'll just make sure we got numbers. Half of that, 0 to 32 is 0, 32 to 44, half of that subject. 35 minus 32 is 3,000 times one half, or 50.5%. $1,500 will be subject to taxation. You with me so far? In fact, I emailed Dave. This is where it gets confusing. I said 3,000 would be subject to taxation because I forgot you got to tax that times that by 0.3 or 0.5. So now what we do, all right, and those, as we say, $1,500 is our AGI. All right, so $1,500 our AGI, but we have, in this case, we'll just say 24,000 standard deduction. So our taxable income equals whatever that is, 22,500. I mean, our taxable income is minus 22,500. So we pay no tax. I hope that makes sense. It's actually critically important to understand how that works. Remember, you got to figure out your provisional income. Your provisional income, they got to figure out how much of that provisional income will be subject to income tax. In this case, it's $1,500. That was it, $1,500. But that's not your taxable income. That just goes to your bottom line on line 37 of your 1040, which will be changed until when the government gets back together. And hey, more power. They want to keep holding out. I'm fine with that. Less government is more freedom. More government is less freedom. No other way around that. So you take your $1,500, you subtract out your standard deduction. That's your taxable income. In this case, it's a minus 22,500 for taxable income. Easy as pie. So Dave, I hope that helps. Again, I had emailed you back and I said $3,000 was your taxable, your AGI, $3,000. It actually was $1,500. Either way, you still pay no tax. So remember, if all you have is Social Security, you're not paying any tax. There's no two ways around that. If all you have is Social Security, you're not paying any tax because simply after provisional income, which is only half your Social Security, after $32,000 of that half of Social Security is not subject to taxation anyway, there's no way you're going to get enough Social Security to get above the standard deductions. And then, of course, your standard deduction is even higher if you're over than 64 years old. So hope this helps. You like what you see, subscribe down below, and we'll see you next. And don't forget to comment and thumbs up, and we'll see you next time. Thanks, guys.